Hello, vetted VA community. It is Helmer this week with your mortgage market update. Today is February 1st, 2023. This year is rolling along very quickly. I am joined today with our guest, Aaron Clark. Aaron, thanks so much for joining us. Please go ahead, take a minute, tell everybody a little bit about yourself.
Good morning, Aaron. I'm the owner of Firehouse Mortgage in Houston, vetted VA4, and let's see what Helmer has to say today.
All right. So if you are here live, please go ahead and say hello. Let us know. Let us know if you are a consumer or a professional. We do broadcast this in a few different places. Also, if you're watching on the replay, do us a favor. Give us a hashtag replay. Let us know that you are watching and that you find this information helpful each week. We'd love to know that many of you can't make it live, but that you are watching and that we're giving some value to you. And if you have any questions or comments, of course, if you're here live, we are definitely here to answer those for you. Last week, we had a great conversation with one of our veteran members, either veteran or veteran spouse, but either way, buying a home, and we were able to give them some insight into what was going on with rates and their particular situation. So we're always glad to answer any questions you have. If you do happen to find this and we are no longer on live, definitely post your question. We do monitor these posts and we'll make sure we answer it for you. So, all right, man. Well, let's go ahead and we'll dive in first. Let's jump right over to a rate recap. Give me a minute and I will pop this up on here and let's talk a little bit about, all right, remember, this is not an offer to lend. And when we're talking about rates, we're talking about averages and generalities. You always want to make sure when you look at your unique situation, things that can affect your rates include your credit profile and some what part of the country you're at and a couple of different things there. So, and as always, we always encourage you to shop your rate. But what are we seeing? Well, for me, I think rates have gotten slightly better over the last week, not significantly. You might be looking at maybe 1/8 of a percentage point in actual rate. So from say 5.875 to maybe 5.75. More likely, when we say rates have gotten slightly better, you'll sometimes see a little bit more of a rebate in your closing costs. Your lender is able to give you a little bit of money towards your closing, or it will cost you less to get a better rate. VA rates are generally in the high 5s to low 6s right now. If you're finding that you have a rate in that realm, you are most likely in a decent place. Anything higher than that, you definitely want to get a second opinion. I've actually heard some VA rates getting down into the mid or even lower 5s. Aaron, have you seen anything? What's the lowest you're seeing for VA rates right now for any of your VA borrowers?
I'm seeing above 700s, low to mid 5s. We have some, depending on the loan amount, of course, but we've seen some 5.1s here in the last couple of weeks.
Okay, so that's even better. So, I mean, you may see rates, again, shopping around, you may see rates that are in those lower 5s. If you're looking at a conventional loan for any reason, those rates tend to run a little bit higher. You're going to be in the low to mid 6s. Otherwise, rates are being influenced right now by cooling inflation, which is a good sign. Inflation is one of the biggest reasons we've seen rates go up as fast as we have over the last year and a half. And we've seen some reports last week that showed inflation was moving down a little bit lower. The personal consumption expenditure report, which is the Fed's favorite gauge of inflation, there's growing concerns about a recession, which of course are also affecting the market. Recession will be bad for the people, but good for housing. So when we hear a lot of talk about a recession, that's something that actually helps rates a little bit. Anything in the last couple of weeks, Aaron, for rates that you would add to this?
No, spot on. Conventional's been low 6s, mid 6s, and VA's been in the mid 5s. So right on.
Okay, awesome. So let's talk a little bit about our rate forecast. This is where things get very interesting this week. So today we could see rates get a little bit crazy. And if you have locked in an interest rate today, then you don't have to worry about that rate moving. Once you've locked, that means that your rate is now protected. However, if you're out there house hunting, or if you have a while before you close, maybe new construction, or if you are, even under contract, but you have not locked in an interest rate, you may see some movement today. And we don't necessarily know which way that will go. If I were to play the odds, though, I think we're going to see an opportunity for rates to improve from here. Now, I may be a little bit of an optimist, but I do think that we have a chance to see rates actually start to maybe go a little bit lower. So all eyes today are on a Fed meeting. So the Fed meeting started yesterday. It's a 2-day meeting and it concludes today in about 2 hours. So at 2 p.m. Eastern time, the Fed is going to come out with their policy statement and they're going to talk about the Fed funds rate. And that is their policy rate that they use to basically influence the rest of the economy, the markets, other interest rates. And the Fed is expected to go ahead and raise that Fed funds rate today from 4.25 to 4.5. So they're expected to raise that rate 0.25% today. Now, when you see all those headlines about the Fed raising rates, you don't have to worry about that pushing your mortgage rate higher today. When the Fed raises their Fed funds rate, it does not have an instantaneous effect on mortgage rates. The Fed does not set mortgage rates, okay? Mortgage rates have already anticipated this move, and as long as we see that 0.25 point rate hike, that by itself would actually support rates staying where they're at rather than moving higher or lower. Anything, Aaron, that you would add to that?
No, sir.
Okay. What we're looking at now, and the reason we're going to see what I like to call the Fed fireworks today is expectations of what the Fed is going to do next. And that's what traders and markets are looking at. Now, I want to jump around a little bit for you. We're going to come back to that forecast, but we're going to talk for a minute first about, why do mortgage rates move and what does that actually look like? So I think we've got to kind of understand why rates move to understand what the Fed action today is going to do and why it's going to move mortgage rates. So rates are based on the bond market, specifically a particular bond called a mortgage-backed security. And the better or worse that those bonds are performing, the better or worse that rates get. So forgive me, I touched my mouse and it gets a little wiggy here. So let's go back. There we are. So right now, this is what we're actually monitoring. This is that mortgage bond market that we talk of. And I'm going to zoom in on this for y'all. And I want to show you all of these little lines. These are called Japanese candlesticks. This is a Japanese candlestick chart. And the reason they call these candlesticks is because when we look at the top of one of these, we see, that's a little too, there we go. When we see the top of one of these, we see what we call a thin line that's called the wick. And it looks just like a candlestick, right? So we've got a fat body, we have a wick, and then at the bottom, we have what's called a tail. Now, the color, you'll see that there's red and there's green. The color depends on where we saw these bonds start their day on their pricing and where they ended the day. When they improve, they go green. And as we see this trend where kind of the line that these form move higher, that's actually good for mortgage rates. The higher these bonds sell for, the better your mortgage rates are going to be. If we see a downtrend and we see some red candlesticks, that's usually when mortgage rates creep up and get a little bit worse. Are we still here? That was weird. It reset itself, but I think we're good. So that's why you haven't seen rates move too much over the last couple of weeks, because we haven't really seen this in a longer period go up or down. And you can see where sometimes these go straight down, sometimes they go up. Now, today we're expecting to see a longer, larger line. That's because we're going to see more movement based on what the Fed members say. Now, markets, this is set by what traders are trading and where they're buying these bonds. And the higher that they pay, the better your mortgage rates are going to be. The lower that these bonds go, the worse the mortgage rates are going to be. Now, traders have been anticipating, where do they think the Fed is going to go over these next few meetings? And based on what's said today, in two different distinct areas. One is going to be the Fed policy statement. The other is going to be the press conference from Fed Chair Jerome Powell. But based on what markets anticipate the Fed's moves to be for the rest of the year, we're actually going to see mortgage rates react today. So in a nutshell, to make this a little bit easier to kind of wrap your head around, if the markets, if traders believe that the Fed is close to ending their rate increases. Remember, at the beginning of 2022, we had a 0% Fed policy rate. We ended 2022 at 4.25%. They're expected to go to 4.5% today. At the next meeting in about 6 weeks, they're expected to go one more rate hike for another 0.25 point to 4.75%. If markets think that the Fed is going to pause their rate hikes because the Fed has basically been able to get inflation to reverse, then that's going to be good for mortgage rates. And we'll see that this chart here is going to kind of cap out at 4.75. And as we look at each of these future meeting dates where markets expect the Fed to hold that interest rate. Now, if today that we get comments from Fed Chair Jerome Powell, or if the policy statement somehow leads markets to believe that the Fed is going to raise rates higher or keep those rates higher for longer in their fight for inflation, then we'll see mortgage rates react very quickly today and get worse. So it's not today's Fed action that's actually going to affect where mortgage rates go. It's the expectation of where the Fed will be in March and in May and in September and November at these future meetings. So that's what we're going to be watching today. And if you wanted to have kind of remember Cliff Notes, Aaron, you're about my age. Remember when we went to high school, if like you were looking to do your English paper, you didn't read the book, you buy Cliff's Notes. They were just the short bridge, right? So if we had the Cliff's Notes version of what we think is going to happen, here is what that actually looks like for you. What we would see is we want to watch the 10-year Treasury yield. Right now, that 10-year Treasury yield is at 3.48. So if you go to like CNBC 10-year Treasury, right? And if we Google that, you can see what that 10-year Treasury yield is in pretty close to real time. So right now it's at 3.479. We want to round that to two places. So it's 3.48. If we see this Treasury yield go down, if this number goes down, that's going to kind of forecast for us that we have a good chance for mortgage rates to actually improve. If that 10-year Treasury yield is going to give us a clue on where things are going to go next. So if you see that yield go down, that means that there's a chance that we could see lower mortgage rates to come over the next few days or few weeks. If that 10-year Treasury yield goes up, that means that we're more likely to see mortgage rates creep a little bit higher. Now, the 10-year Treasury yield does not set your mortgage rate, but it is basically the granddaddy of bonds. And in the direction that this move is generally where we see these other ones that we talked about, these mortgage-backed securities, move in a similar direction. So today, if you were just going to say, hey, Hammer, really and then at around 2:30, you want to watch it again, because what's going to happen is at 2 p.m., the Fed releases their policy statement and they say, okay, we're going to raise rates by 0.25%. Remember, that's not going to hurt your mortgage rate. It's not going to drive mortgage rates up. It's actually already been priced in. And they're going to say, but over the next few meetings, we're going to be watching data. And that's what they're going to really do. They're kind of vague. And markets are going to read into that, whether there's a word here or they take a word out there. And we see bonds move. And then at 2:30, Fed Chair Jerome Powell, he's going to have his press conference. He's going to answer questions. And that's really where we see a lot of activity. So what will happen is during that press conference, you're going to see markets start to move in a direction. If markets believe that the Fed is done with this rate raising cycle and that we are seeing inflation kind of get managed, that's going to help mortgage rates to be in a position to improve. If it goes the other direction and they think that the Fed may have to raise rates again March and in May or go higher, that's going to make mortgage rates a little bit higher. So I know there was a lot there, but kind of basically trying to put it all in there and break it down for you. So hopefully that helped. Aaron, what do you think? Is there any questions on that or anything you would add to that one? I know I did a lot of talking there.
There is. If we see the 10-year yield go down, mm-hmm. When do you think the pricing will adjust? And is it just for that day, or should it be good for a week or two? Or
right, those awesome. Those are great questions. So what we want to do is put ourselves into the mindset of a mortgage lender, the companies that actually set their interest rates. Now, we've talked about this before. Mortgage rates, they're based on that bond market, as well as the second component, which is the lender has to make a profit. These are companies and businesses and with staff to pay, and they're looking to make money. So what happens is if they think that this is only a move that's going to last for a day or so, they may not necessarily pass those gains on to the rate sheet. So we may not see mortgage rates move very quickly. So it might take a day or two of where we see that 10-year Treasury yield being lower, things being improved. Then the lenders are a little more comfortable and they'll pass those gains along. So it may take a day or two to hit the rate sheets for some lenders. Other lenders are very quick to make changes. And especially, Aaron, you've been in this business for a long time. So you know lenders are very quick to price worse, but much slower to price better. So if we do see a negative reaction to this Fed meeting today, lenders are going to reach out and they're going to say, okay, Aaron, that rate quote we gave you at 10 o'clock this morning, 10 o'clock Eastern, well, it's not good anymore. Its rates are higher than what you saw then. And then unfortunately, as Aaron knows, that is going to be passed on directly to the consumer. So that's why we see what we call reprice risk today, where rates can move. We don't have to wait till tomorrow. We could see that movement today. If it's a good movement, it takes a little bit longer sometimes. If it's a bad movement, it tends to hit very quickly. So and then as far as over the next couple of weeks, we'll see. Generally, you have to see that dust settle. We do have some other influences that are coming in that we won't go too deep on, but what's happening here in the United States is our primary focus. But we're a global economy. So tomorrow we've got the European Central Bank and I think the Bank of England, and their central banks are meeting and doing the same thing. They're having the same conversations. And we actually do see that affect our rates in overnight trading. So we can actually wake up tomorrow and see rates that are a little bit better or a little bit worse based on what happens with the European Central Bank and the Bank of England. What else we got?
No, that was good. Thank you.
Okay. So let me ask you, do you think we had a couple of other reports this week? Did you happen to see with Case-Shiller or the FHFA price, home prices? Did you see whether home prices dropped 20% or dropped 2% or went up 5%? Have you seen any of that or?
In our market, I've seen home prices drop a little, but the buyers are able to get more seller concessions than pricing drop. They're keeping their value, but the buyer's able to get credit to help with closing costs.
Right. So you're seeing what we've talked about in some of the other ones. Would you say that people should be afraid of buying a home now because home prices are going to drop after they buy it? Or do you think we're in a market that home prices are pretty stable?
I think the home prices are stable. It's whether or not what's the rate going to do.
Yeah,
we've been telling our clients buy now. You can always refinance, but that house more than likely is going to increase in value by this time next year.
Yeah, and that's the catch-22 is if rates go down and you say, okay, great, now I've got more buying power. Well, when rates go down, we see that bidding war stuff kind of increase. We see asking prices go up a lot quicker. So you don't tend to get a full advantage of that. If rates go down, it doesn't mean that home prices are going to stay. They'll probably see them creep up a little bit, a little bit faster. So it's definitely, we've found a sweet spot right now where you've got, what I've got on the screen, like a home buying advantage. There's more homes on the market. It's still an inventory issue, though. We don't have huge inventory nationally. What about in your market, Aaron? Are you seeing, is there a lot of inventory or are things still moving, within 30, 45 days?
I think the homes are staying on the market a little longer. There's definitely more inventory than there was 6 months ago. And it's a good time to buy now. People are wanting to move once school gets out here in the next month or two. So you're starting to see those homes come on the market.
Right. We're seeing that spring market kick in.
Exactly. And if interest rates do go down, increase the buying power, they're going to increase the home price as well, like they did last time. So right now you can get a home for relatively what it appraises for and get seller concessions to keep your money in your pocket.
Yeah. And that's a really great thing to bring up, is that a seller concession, for those that may not be too familiar with that, is when the seller actually provides some of the funds towards your closing costs. What can they be used for, Aaron, for a VA loan?
For a veteran, they can be used to pay your fees, your title fees. It can be used to cover your escrows if you do escrows. And with the veteran, they can actually, if there's left over, they can use it to pay off some of their debt that they have.
Yeah. And so there's a lot of advantage to that. Definitely talk to your, mortgage professional, your real estate professional about what are your options to ask for that if you're not under contract yet, and if you're out house hunting and taking a look at that. But overall, what do you think is going to happen, Aaron, with rates? Do you think rates are, in a good spot now? Do you think they're going to go a lot lower? Do you think they'll go a lot higher? What is your take on where you think rates will go next?
I think we'll probably see rates get better throughout the year, but they're not going to be back in the 2s and 3s like we saw before.
Yeah.
I think, if we can get back in the 4s to 5s, I think that's where they'll kind of level off.
I agree with you. I think that's probably what we would call healthy market conditions. Remember, everybody, rates that went into that 2%, 3% range were because of the pandemic and the response to the pandemic. The financial and monetary stimulus that was done to, counteract what was being done with the shutdowns and things. And if we were to see rates go into the 2s or the 3s again, it would mean that we have a large economic problem that we hopefully won't have to deal with. Maybe mass unemployment, a huge recession. So we don't want to see those kinds of rates, because that means that there's a bigger problem going on. And it's very unlikely that we would see that. Those were true. All the headlines, historic lows. I think those were the true historic lows. I don't think we're going to revisit those again, but I agree with you. I think 4s and 5s are great rates for 2023. And I think that also helps to keep the home prices in check, so that we see a healthy increase in home prices, but not that ridiculous 20-25% increases we were seeing year over year for a while, with some of the nuts bidding wars and people being forced to waive concessions and appraisals and things like that. So awesome. Well, anything, Aaron, that you want to add, or anything that you would kind of tell everybody as far as, about either rates or the housing market, or why now's a
No,
good
I just think if you're in the position to buy right now is actually a good time. If rates do get better, you can always refinance, but the same house is probably going to be more expensive the longer you wait.
Yeah, I would absolutely agree with that. So, well, awesome. Well, thanks again for joining us this week, Aaron. I appreciate you. And anybody, if you do have any questions, remember that we do this each and every week. Where's my little happy? Here it is. So you can join us next week. Let's see. I got my little slide tool here. Where will you go? I got our times. There they are. So join us each week, 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. Next week, we'll take a quick look back and see what happened at this Fed meeting. We will do a recap on where rates went from here, and kind of a forecast on where we think things will go from there. But otherwise, thanks again for joining us, man.
All right. Thanks for having us.